Hi everybody, Thomas here at Rebel Income. A critical element of a winning investing system is the frequency at which you can repeat the same kind of winning trade over time. Investors tend to think about making money by taking the biggest swings possible, hoping for the biggest possible profit on a single trade or limited set of trades. Whether your goal is to build wealth over time or to generate useful income from your investing capital right now, the truth is that you can do a lot better than taking those big swings and hoping for the best. Over the last 3 decades as an investor in the stock market, I've learned a few powerful principles that don't just shift the odds in your favor, they increase your profitability significantly over time. Now, before I tell you about these critical principles, I want to take just a minute to invite you to check out my Rebel Income Patreon page. I publish daily exclusive access content on this page, from stock reports detailing my analysis in search for the trades I publish for my Rebel Income trade alerts, to lists of underpriced dividend-paying stocks, and even weekly recordings discussing current open trading positions and current market conditions. You'll find the link in the description area of this video. Take a look. I know you'll find something you'll be able to use in your own trades. One of the biggest keys to a successful trading system is how effectively a profitable result can be reproduced in subsequent trades. It's true that sometimes you might buy a stock or an option just in time for a big move that nobody anticipated, but those are rare and impossible to reproduce on a consistent basis. A winning trade that can only be attributed to sheer luck, it's fun when it happens. But counting on these kinds of trades is a bad way to build a long-term successful investing system. While the direction a stock will move at any given time is impossible to completely predict, there are ways to build your system to maximize your odds of success. One of those ways is by avoiding the biggest mistake that most average traders make, which is to work on the buying side of the market where probabilities of success are the worst. That's why I prefer working on the selling side, which for my Rebel Income system means selling put options on stocks I'm willing to own and selling covered calls against stocks when those put sales result in buying the stock. If you're new to selling put options or even to using covered calls, it's natural to lean towards selling longer periods of time since the premiums for those kinds of contracts are so obviously higher than selling shorter periods. Experience, however, has taught me that if you want to take maximum advantage of the edge being a seller gives you over buyers, selling less time is more effective. The reasons selling less time is better than more are twofold. First, selling less time means there is a shorter window of time for the stock to move significantly against you. That immediately improves the odds that you're going to be successful. The second reason is the most powerful, and that's why we're focusing on it in this video. Selling less time means you'll be able to place more trades, a reality that I like to call trading frequency. Added to the increased odds of success, placing more trades means you'll start to leverage a compounding effect in your trades. Now, when most of us think about compounding, we think about the standard basic definition of interest paid on interest earned. With income-driven option strategies like put selling and covered calls, I like to think of compounding as the effect of trading frequency over time. When you think about income generation over time, it's natural to frame that income in monthly terms. To demonstrate what I mean by compounding, I'm going to use a stock I've been using in my own Rebel Income trades, Suncor Energy Incorporated, stock symbol SU. You can see the actual trades I've been working with on this stock using the link to my track record that's down in the description area of this video. To start, let's look at what put options are available right now for a put seller on a monthly basis. With Suncor sitting just a little bit above $32, the $32 put is the at-the-money contract since it's closest to the stock's current price. Since sellers always sell at the bid price, selling the $32 contract right now would bring in $1.12 per share per contract. Since one option contract controls 100 shares, that means the put seller agrees to reserve $3,200, for which they get a $112 credit to their account. Now, to put that credit into proper income generating context, we can divide $112 by $3,200. That means this trade would provide an immediate 3.5% yield to the put seller for the 34 days that it covers. If the stock stays above the $32 strike price that was sold at expiration 34 days from now, the $3,200 that was used to secure the trade is freed up and can be used again for a similar trade. Repeating the same process every 34 days means that over the course of a year, 10 trades can be made. Assuming you get a comparable return on each trade, that translates to a total return of 35% for the full year. Now that we've seen a practical example of what is available right now for a 1-month period, I want to show you how to accelerate that practical result with an example from one of my own recent trades. This is the trading confirmation for a put selling trade I placed on Suncor Energy on January 17th, a little over 2 weeks ago. The stock was a little above $31 at the time, making the $31 strike price a practical trade. The positive $50 credit that you can see refers to the price I sold the option for. I sold one contract for 50 cents per share. The number on the right is the new balance in my account with the $50 credit applied. For the 1-month trade we were just talking about, the premium received was more than double this amount, but it also covered a longer period of time. My actual yield in this trade was 1.6% for a 2-week trade. With 52 weeks in the year, being able to place a new trade every other week means I'll be able to use the same money in as many as 26 trades. That larger number of trades is where the real power of selling less time is seen. If I can replicate the same 1.61% result every 2 weeks, my total return for a 1-year period of time is nearly 42%. That's a 7% improvement on a yearly basis compared to the 10 trades I could place every 34 days. My normal approach to put selling is to let the trade expire. If the stock is above the strike price I sold, the option expires worthless, and the capital I used to reserve the trade is available again after the normal 2 to 3 day trade settlement for my next trade. If the stock is below the strike price I sold, I'll take the assignment and start looking for opportunities to sell covered calls following the same time per trade logic that I just showed you with my put sale on Suncor. There is another alternative that I've seen a lot of the people I've worked with start to use in their own put selling trades. Rather than waiting for expiration, some traders prefer to take a more active approach to trade management. If the stock is above the strike price they've sold before expiration, that means they'll often have opportunities to buy the option back from the market for a fraction of the price they sold. That means that they'll accelerate their income generation even more because they're putting trading frequency to work for them even more. Now, let's go back to my put sale on Suncor. The day before the February 2nd expiration of my $31 put sale, the stock was a little above $32.50 per share. That meant that if I wanted to close my put sale early, I had an opportunity to buy the contract back from the market at the ask price of 5 cents per share. I would keep 45 cents of the 50 cents I originally brought in and immediately eliminate the potential obligation a day earlier than the expiration day. One day might not sound like a very big difference, but this is where an active management approach can have an underappreciated impact. That's because buying an option back from the market before it expires frees up the capital used to reserve the trade immediately. Buying this contract back on Thursday, for example, means that on that same day, I'll be able to consider redeploying my capital on a new trade right away. Letting the option expire worthless, which is my normal preference, means that the same capital won't be available until Tuesday or Wednesday of next week. That active management approach increases my trading frequency to 28 trades per year. If I choose to buy the option back, I have to decide what I'm going to do with the capital next. I've shown the next 2 weeks of available put options. With the stock now above $32.50, I could sell the February 9th $32 contract for 41 cents per share. That's another 1.28% brought in on top of the 1.45% return I finished the February trade with if I bought it back. If the stock is still above $32 on February 9th, I'll have a net 2.73 result for about 3 weeks of time. On an annualized basis, that means a potential total annual return of nearly 46.5%. Now, 5% per year of additional return over the less active result I follow doesn't sound impressive. Consider what happens with an extra 5% return year after year over time. Over 5 years, you'll improve your results by at least 25% on a very simplified basis and 50% over 10 years compared to my less active selling approach. That equates to real growth and real wealth over time that is available to anybody that's willing to take the time to apply the principles of trading frequency and compounding in their own trading systems. Thanks everybody for your time. As always, I hope you found this to be useful. If you like my content, please do go ahead and like this video. Also, you can click here to subscribe to my channel. You'll get notifications about each new video I publish. You can also click here if you'd like to see another example of the kind of content I make available on this channel. Thanks everybody. I'm Thomas. Talk to you again soon.